Joining us for our TVFCU Mortgage Seminar Series. Again, Brian Fryer, Mortgage Sales Manager here with TVFCU. Today, we're going to carry on our series. Today, we're going to talk about the different mortgage products that TVFCU offers. I kind of want to go over those. And we're going to get into a little bit of detail here, so you may want to take a few notes. Also, we have some questions that some of you have asked. I'm going to try to address those towards the end of our program today. So let's just go ahead and get right in it this morning. In our other seminars, products, or seminars we've done previously, we touched on purchasing home and getting pre-qualified. Then we also, in the next one, we followed up and did refinancing. So today we're going to talk about the different products that you can do in order to purchase a home or to refinance. So let's just go ahead and get on into what TDFCU offers. TDFCU, like a lot of lenders, we offer a in-house product. We call those portfolio loans. Those are loans that TDFCU holds and then we service. Then also we do what we call secondary market loans. A lot of lenders across the United States do secondary market loans. And if you've heard some of the names of Fannie Mae, Freddie Mac, FHA, VA, those are known as secondary market loans, generally government backed. So there's some good points with each one of the secondary market products or your portfolio loans. I want to kind of delve into those a little bit. First, I'm going to go into the secondary market just because that is probably the most common types of loans in the United States. Also want to touch on as far as the secondary market loans, generally those loans are going to be sold to an investor. So your lender, whether it be TVFC or someone else you go through, are not going to be holding that loan. They're going to go through Fannie Mae or Freddie Mac or FHA or something like that. In our case, we go through Freddie Mac with our investor. So we have to adhere, when we do those types of loans, to the guidelines Freddie Mac requires. Those are pretty broad. They're also too, when you're talking about secondary market, you're generally going to find your best interest rates because those loans are sold on the secondary market. So your interest rates are going to be very good on those, and especially right now since COVID hit back in March. Everybody knows, the mortgage rates are at a historic lows. And I know in my 20+ year career, the lowest rates I've ever seen, and going back historically, some of the lowest rates we've seen in history. So I want to kind of talk about the secondary market loans. Generally, in your secondary market loans through TVFCU, we do a 15-year fixed, a 20-year fixed, and a 30-year fixed. Those rates are very good right now. I'm not going to lie to you about that. But they're pretty much cut and dry, these type of products going through secondary market. You can do a purchase a home, or you can do a refinance. Refinance to get a better interest rate, lower your term. You can get cash out if you have the equity in the home. On the secondary market loans, generally it requires at least a 5% down payment. Now, with our investor, one of the products we have only requires a 3% down payment called Home Possible. It's a great product. It's a minimum down payment. The down payment can be your own funds. They can also be gift funds from a relative too. So you want to talk to your mortgage professional about what kind of down payment you're going to be putting down. And also too, I want to talk about secondary market loans with TDFCU and anyone through, if you go through Fannie Mae, Freddie Mac, FHA. As far as PMI, that's another question that comes up sometimes. And I think we had a question about PMI. What is PMI? Generally, on a secondary market loan, if you don't put 20% down payment, you're going to have to pay private mortgage insurance. It basically, what mortgage insurance does is it protects the lender, Fannie Mae, Freddie Mac, if the loan goes bad. So if you don't want to pay that monthly PMI, it will require at least a 20% down payment. So do keep that in mind. Secondary market loans generally do require at least 20% down to avoid the monthly PMI. That PMI does drop off after a certain period of time, your equity and the value of your home. Technically, I think it's a 78% loan to value. It will drop off automatically. So that is something that do be mindful of. You'll have that on there for a while, especially if you do like a 30-year loan where your equity builds slower. You're not paying as much for the principal because it is a longer term loan. But secondary market loans, they are an excellent product. They are very cut and dry. They're black and white. they do have rules, and you do have to follow their rules to be able to qualify for those. Um, Also, some people ask about, what if I'm self-employed? Well, if you are self-employed, you can get a loan, but we are going to have to look at your personal and business tax returns in most cases. So do keep that in mind. It does take a little bit more of a look for your loan officer to make sure you can qualify with the type of income that you report. And of course, it is reported income. Um, can't go off of, bank statements or anything like that. So they are very strict on that. So just want to let you know, if you are self-employed, to make sure your mortgage professional is looking at your tax returns to make sure you can qualify. More on secondary market loans as well. The the when you do a loan through a lender and they have a secondary market loan, and chances are it is going to be sold, and in our case those loans are sold to our investor, and they will service your loan. Some people want they want the ability to be able to keep their loan with the lender, which in our case TVFCU, we offer portfolio lending. We call that also our in-house loans. We keep these loans in-house. We do underwrite to secondary market guidelines, but we also have a little bit of leeway too, because since we are keeping those loans in-house, we're taking on a little bit more of the risk, so um, um, we can be a little bit more lenient on some things. Some people ask about, your portfolio loans. What is your at TVFCU? What are your best products you have? One of the best things we have here on our portfolio loans, we have a 100% purchase, no money down product. And that loan is kept in-house. And also too, all of our in-house loans, our portfolio loans, we do not require monthly PMI for the most part. Since we're keeping it in-house, we're holding the risk. Your interest rates on these are going to be a little bit higher just because we are keeping them in-house, and we're taking on the risk on those loans, not selling to an investor. But we do have the 100% product for a purchase for a single family home primary residence, and that's what we here at the credit union we kind of consider our first time home buyer product. It is geared for anyone though. Even if you're not a first time home buyer, let's just say you have the money to put down, but you don't want to use that money. You want to keep that money liquid, but yet you can qualify for the no money down product. It's an excellent product. Again, it has no monthly PMI. Your interest rate is going to be slightly higher than a secondary market, just let you know. But that loan is kept in house, and there's no money down requirement. Now, can I put money down? You can, all day long. Put 5% down. You can put 10, 15, 20% down. It depends on what your situation is. Sometimes people want to build equity faster, so they're going to put more money down. Sometimes they don't want to use that money. They want to, like I said, they want to keep that liquid, and maybe pay down over the life of the loan. So that is an alternative for you if you didn't want to do a full 20% down, 5% down, like on a secondary market loan. Also, too, here at the credit union, we do unimproved property loans, and that is a very popular product that we have. We on that product, and when I say unimproved property, we do have to be very careful, just because sometimes people will look at a piece of land, and even though it doesn't have a house on it, it may have a structure of some sort. In most cases, it cannot have a structure whatsoever on the property. We have seen sometimes it might have a small little wooden barn, something like that. That's generally, something we want to look at on a case-by-case basis. But of course, if that unimproved property has a warehouse on it, or a large storage metal building, that's not considered unimproved property. So it may be more towards the commercial side. So just want to be cognizant of that, and make sure that when you are talking about unimproved property, it is residential, unimproved property, does not have any structures on it. But here at TVFCU, we do those types of loans all day long, all day long. And as far as terms on those, we can go up to, if I'm not mistaken, we can go up to a 10-year fixed on those. I'm sorry, 15-year fixed. And it does require at least a 10% down payment. So just an FYI. Those funds can be gifted I'm sorry, cannot be gifted. Those do have to be your own funds. So sorry, it is early in the morning. I'm not having all my coffee yet. But again, that is our unimproved property. It's a very popular product, and something also too I would kind of talk about, especially when it comes to low inventory of homes these days. We're seeing a lot of people not able to find a home So they're opting to buy unimproved property because it is available. Just be aware if you're not looking at purchasing a home right now, or if you haven't found a home, but you're looking at maybe buying an investment for the future. Unimproved property is it's a very good thing you may want to look at. So there are lots of properties still available in the Chattanooga area, North Georgia, Southeast Tennessee. So we definitely would like to talk to you if you're interested in some unimproved property. Also, too, people ask us about manufactured homes. We here at the credit union do manufactured homes. We only do double wide manufactured homes with land. So we do purchases, we do refinances. We also do cash out refinances on those as well. So we want to make sure, however, though, when we're talking about manufactured, we only do double wide manufactured homes with land. So just do keep that in mind. And again, this is a good product. We can do those on secondary market. We can do them on our portfolio. Most cases, if you are looking at purchasing a double wide manufactured home with land, does require at least a 5% down payment. Okay, so when purchasing, just remember that at least a 5% down payment. It's going to depend, of course, on your credit and everything, but that's something we can look at if you are in the market. Also, too, on these products too. I'll talk about single family homes, unimproved property. We also do loans on townhouses and condominiums as well. Townhomes, there are certain criteria for townhomes and condominiums. You'll definitely want to talk to your mortgage professional about that, about what the minimum down payments are, what is required. Townhomes generally tend to be not as complicated as a condominium. Condominiums right now are a great property, very popular in some cases, especially in urban areas. We've seen like Nashville, Chattanooga, Atlanta, different places like that. A lot of people looking for a condominium. Generally, it's younger professionals or someone who is maybe retired and they don't want to have to take care of a yard or something like that. So condominiums are a great source to look at if you're looking at purchasing. I will say on the secondary market, those condominiums a lot of times are going to have to, or all times are going to have to be approved, which means they have met certain criteria either through Freddie Mac or Fannie Mae to where financing is available. So that's something you'll want to talk to your mortgage professional about at TVFCU when you're talking to them and looking at purchasing a condominium. We'll need to find out if that isn't approved for financing through Freddie Mac. It's something very important, especially if you're going to go through the secondary market. If it's not approved financing, still have an outlet. TVFCU in our portfolio, we do those on a case-by-case basis. We are more than happy to look at those properties. There are a lot of them downtown Chattanooga area, and in Hamilton County, North Georgia, that may not be approved for financing through Freddie Mac, but we can look at those on our portfolio. We are more than happy to look at those. Basically, we want to look at anything that you might be interested in, and definitely you want to talk to your mortgage professional here at TVFCU. Also, getting back to single-family homes, when purchasing or refinancing. Whenever you're talking to your mortgage professional, you kind of want to look and see where your goals are and where you want to be in a few years. Another thing that we do in our portfolio, we do ARM loans. We have fixed rates. We have a 24-year fixed rate, a 14-year fixed rate, a 10-year fixed rate on a purchase or a cash out refinance first mortgage. We also have 30-year loans, and there are ARMs, adjustable rate mortgages. One can be what we call a 10-1 ARM or a 7-1 ARM. 10-1 ARM, what that means, it's a 30-year loan. It's a fixed rate for the first 10 years of the loan. The 7-1 ARM, it is a 30-year loan. It's a fixed rate for the first 7 years. Now, that being said, it is a fixed rate for the first part of that term of the loan. It's generally going to be a little bit lower interest rate than, say, your fixed rate would be. It's some people call it a teaser rate, something like that. But basically, it gets you in the home at a lower interest rate on a longer amortization for a lower payment. That's kind of geared for people that know they're either going to refinance that loan within the 10 or 7 year period, or they're going to be moving and selling the home. So just to be, be aware, it is a good product. The introductory rate is going to be lower than your fixed rate. And again, it's geared for someone that knows where they're going to be in, 5, 6, 7, 8, 9, 10 years or so. So do keep that in mind as something that we offer. And I'm sure when you talk to one of our mortgage professionals, we're going to go over all the range of interest rates, terms, and payments, etc. So also looking at those loans that we have, that's on the first mortgage side. We also offer investment property too on first mortgages. These are loans that you're looking at for rental properties. So something that is, if you currently own your home, or you're looking at buying a home to make an income off of. Investment property loans are something that we definitely do here. We either do secondary market or we do portfolio lending. Generally on those loans, just to be honest, they are a riskier loan for the lender, whether that be Freddie Mac, Fannie Mae, etc., or on our portfolio. So it's going to require more of a down payment on those types of loans, just because, again, it is a riskier loan for the lender, because historically, if a loan is going to go bad, an investment type property loan will be, they do tend to have a higher default. So it is more of a risk. Those interest rates are a little bit higher on those loans as well too. So do keep that in mind. Rates are great right now, whether it be your primary residence or your investment property, but those rates are going to be a little bit higher than a primary home, just because, again, they are a little bit riskier for the lender. So do keep that in mind. Another thing we do here at the credit union too, we offer second mortgages. We also offer home equity lines of credit. What these are geared for, the second mortgages, let's just say you have your first mortgage, you've refinanced recently, and you're sitting on a great interest rate. You don't want to touch that first mortgage, but you're needing some cash out. You're needing some money to do some home improvements, or you need some money for a large purchase. May want to build a swimming pool. I know a lot of people with coronavirus and everything going on, a lot of people have been doing a lot of home improvements to their homes. So that's something that you definitely want to look at. If you already refinanced, you have a great interest rate, you may want to look at a second mortgage or a home equity line of credit. Now, there is a difference between what we call a fixed rate second mortgage and a home equity line of credit. A fixed rate second mortgage is going to be a loan for a fixed term, generally for a fixed rate, and it's going to be a fixed loan amount. That loan amount will not change. So if you have an amount that and you take a loan on that loan amount is the money that you get back to either refinance or to pay off debt or use for home improvements, etc. The home equity line of credit is basically, it's an open line of credit, very similar to like a credit card. You have a line of credit that's open, say a $10,000 limit on your credit card, but you only have a $100 balance on it, something like that. The home equity line of credit is similar. Generally, it is going to be a lower interest rate than any kind of credit card you could ever get. So, and it is tied to the equity in your home. Now, the home equity line of credit can be a second mortgage, but if you don't have a first mortgage, it can be your first mortgage as well. So just do keep that in mind. A lot of people like to use the home equity line of credit. And this is one of those that I kind of do recommend for home improvements, especially if you're working on an older home and you do have an idea of how much it's going to cost to do the improvements on the home. Well, I've run through experience. You start knocking down walls, taking out wiring, etc. Those costs can go up unexpectedly. So the home equity line of credit, to me, is one of those products that's is more geared towards the home improvements, because you can take out a line of credit for more than what you plan to and use what you need. Also on the home equity line of credit, another thing that's great about that is you can have, let's say, for example, a $50,000 line of credit, but have a zero balance. You don't pay any interest on it. You only pay interest on what is on the balance of the line of credit. So that's something to be aware of too. So so again, those are the types of loans we do: first mortgage, primary residences, investment property. We do manufactured homes, double wides only, of course, and then we do unimproved property, second mortgages, and then home equity lines of credit as well. Also, at the credit union, we do jumbo loans too. There's a lot of talk sometimes in the industry about jumbo loans. So what a jumbo loan is, it's a larger loan amount, is increased over the years. Um, and jumbo loans are going to be a little bit more risky for the lender because they are such a large loan amount. On the jumbo loans, your interest rates are going to be a little bit higher on those just because it is a risk for the lender. Here at TVFCU, we do jumbo loans. We only do those on our portfolio. So we are going to look at those on a case-by-case basis. But yeah, it's something that we do here at the credit union. And generally on those, it's going to be your primary residence on the jumbo loans. So that's kind of in a nutshell, basically what we do. Kind of a brief overview. I do have a few questions here that I wanted to get to and see if we can answer from some of our some people that have logged in. One just a real basic question was, want to know, how do you refinance? If you currently own a home, of course, you can take money out, or you currently have a loan on it, that's going to be a refinance. If you're just refinancing what's the current balance, that's no, and you're just redoing the balance, that is what we call a rate term refinance. You're just refinancing the rate or the term or both to get a better rate, better payment, or something like that. Cash out refinance is going to be where you're taking out extra cash, getting equity in your home to do a home improvements, or you're going to be doing some debt consolidation or something like that, paying off some credit cards, automobile loans, or something like that, putting it all in one payment. Now that's going to depend on the equity that you have in the home. So that's something that you want to, if you're looking at refinance, you want to see, look around online, look at Zillow, see what your home might be worth. And look at your balance, your current mortgage balance, how much you owe on the home right now. So that's something that you may want to do a little bit of your homework before you contact a lender, and just see, if it's possible. If you don't know these questions, you can talk to your lender. We have some outlets we can look at, maybe help you along. Look at the tax assessment on the property. Zillow's, sometimes is a good avenue to look at. I will say it's not 100% because generally an appraisal has to be done on the property. Let's see if we got some more questions here. Bear with me just one second here. A question was asked, do we currently offer construction loans at TVFCU? We do not currently right now. We have offered them in the past. We are redoing our construction product. We hope to have that out maybe 2021 is one of our goals, to get the construction loans back at TVFCU. Another question was asked, if they currently have a construction loan, can they roll that over to TVFCU? Yes. If you have a construction loan right now and you're working with a lender and you want to come to TVFCU and see about either, if you can keep the loan at TVFCU, we'd definitely love to look at it and see if we can put you in the portfolio, and you make your payments to us, and you'd have your new loan with TVFCU. So yes. If you have a construction loan and it does have to be rolled over to a permanent financing, we want to talk to you. We'd love to talk to you and see what we can do for you. Acreage, purchasing on acreage. That's another question we get. Again, on our portfolio, we're going to look at that on a case-by-case basis. Generally, most of your secondary market loans, they're going to have limits on those, whether it be 10 or 20 acres. If there are limits, then we can look at on our portfolio where we're a little more lenient as far as the acreage goes. Here's another question. Do you go up to 100% financing? Yes, I'm going to roll back to that. We do 100% financing on our purchases for primary residence. Again, no PMI on that or anything like that. We also do 100% financing on our home equity lines of credit and on our second mortgages as well. So again, those are primary residence. We will go up to 100% of the appraised value on those. So yes, that's an excellent question. I do know in our area, I'm just going to toot our horn here, I think we're probably one of maybe the only lender or a few lenders that actually do 100% financing on home equity lines of credit and on second mortgages. So if you're needing maximum equity out of the home and you qualify, the 100% home equity line of credit or second mortgage, if you didn't want to refinance or you couldn't get enough cash out on a cash out refinance on a first mortgage, is going to be a great avenue for you, just because you can tap in that full equity in the home. Let's see here. Asked about currently have what I consider a low rate, 3.65% on 30 years. Are rates low enough that refinancing possibly at 15 years could make sense? That's an excellent question. It's one of my favorite questions that I get because I'm a really big fan of a 15-year fixed rate. The reason being is the rates on those, the shorter your term, the lower your interest rate is going to be. So a 30-year rate as opposed to a 15-year rate, there's going to be a difference. Now, what we find is when we're talking to people, they're on a 30-year fixed rate currently and they have a good rate. And we talk and like, well, I want to lower my interest rate. Well, let's look and see if we can, what your payment might be on a 15-year fix, because in some cases that rate may be so good that your payment, it may not bring your payment down, but what it's going to do is it's going to be very close to what you currently have on your 30-year loan because rates have gotten so much better. And your mortgage professional, your mortgage originator at TVFCU can run those numbers for you and see if it would be a possibility. Now, you're thinking, well, Brian, I want a lower interest rate and I want a lower payment. Well, you may want to look at still staying on a 30-year fix, but here's the advantage of going to a 15-year fixed, in my opinion. You're say you've had your 30-year loan for about 3 or 4 years. You're paying some equity, but let's just be honest, on a 30-year loan, the amortization schedules, you're not really paying a whole lot towards the principal on a 30-year loan, especially, so far out at 30 years, 29 years, 28, 27. If you roll that into a 15-year, you could possibly have a lower interest rate. Now your payment may not be a whole lot different. In some cases, maybe a little bit more, but the interest you're going to save over the life of the loan is going to be astronomical, to be honest with you. So I always tell everyone, when you bought your house 2 or 3, 4 years ago, and you're on a 30-year fixed, your rate is good, very good. But let's look at a 15-year fixed. If you're looking at paying your home off in 15 years or so, maybe you have small children, and your goal is to have that home paid off by the time they go to college, or you want to have the home paid off by the time you retire at 65 or 70 or so. So 15-year fixed rates right now are fantastic. I do highly recommend, if you're looking at just doing a rate term refinance and you've had a 30-year loan or you've had an adjustable rate mortgage, looking at a 15-year loan is very, very, to me, it's a good idea. It's a great idea, especially nowadays with rates being so low. Because we're in the rate environment we're at right now, we're in the low twos to mid twos on a 15-year fixed. The 30-year fixed, we're in the upper twos to low threes right now. It does, especially on the secondary market, those rates can change on a day-to-day basis. Sometimes they can change 2 to 3, 4, 5 times a day, depending on market volatility with the bond market. So do keep that in mind. Our portfolio rates are going to be a little bit higher than that, just because, again, we keep those in-house and we are taking on the risk on those. Let's see, another question here. I've already found a house and I'm working with a person to get it below market value coming in with the equity. What would work better on my end? Again, if you're trying to get a home lower than market value, by all means, try. I will say in today's environment right now, we are in a very, very low inventory environment as far as homes for sale. Not just in the Chattanooga, Hamilton County area, Southeast Tennessee, North Georgia, all over the United States. Everybody's heard that on the news. The housing market is booming right now. Interest rates are low. Demand is very, very high. But inventory is super low, very, very low. We have a lot of people that are wanting to sell their homes too, but they're hesitant because they can't possibly find a home. Either they're upgrading or maybe even downgrading. So that's something to do be aware of. If you're looking at selling your home and you're wanting to purchase another home, make sure you do your homework as far as purchasing and see what's available and what you can afford. Again, going back to when we discuss purchases and getting pre-qualified, that's very important to get pre-qualified first to make sure you know what your situation is and you'll be able to do a loan. Let's see. Another one. Can our son buy a rental property from us through a mortgage department? He doesn't own any real estate. It would be his first purchase. Yes. You can do purchases from relatives. We do it all the time. We have mom and dads selling a home to their kid. So that's definitely something that it's legal. It's available. You can do it. Investment property, the same thing. Mom and dad have a house. They're going to sell it to their son or daughter, and they're going to use it as investment property to rent out. So yeah, we do those all day long. We'll want to look at the different situations and everything, see which product is going to fit best for you. But yeah, you can definitely do that. Let's see here. Another question. How much down payment do you advise? Kind of want to roll back to that. In a perfect world, you want to put down as much as possible, 20% down, especially going in the secondary market. If you're putting 20% down, you're not going to have the monthly PMI each month. And also your interest rate is going to be probably a little bit better the more money you put down, because it's less risk for the lender. So you're showing that you're putting more skin in the game, as they say. So 20% down is ideal. Minimal for secondary market loans is generally going to be 5% through Freddie Mac, and also if you go through a lender that uses Fannie Mae. But again, with our secondary market investor, we also have Home Possible too, which is a 3% down payment. So do be aware of that if you wanted to go that route. Again, circling back to our portfolio loans, we do the 100% financing, so there is no money down requirement on that. Also, too, want to talk about, and we kind of talked about this when we did this segment on purchases and getting pre-qualified and everything. Down payment, remember that, if you're going to be putting money down, but also closing costs too. You'll want to figure in the closing costs when doing a purchase, if you're going to be paying for the closing costs, or if the seller's going to be paying for some of the closing costs. So that's something you'll want to discuss with your mortgage professional too, especially if you're getting pre-qualified, because you'll need to make plans on who's going to be paying for what, and negotiations. If you have a realtor, you want to negotiate, who's going to pay for those closing costs. And also too, depending on the type of loan that you're in, what's allowed that the seller can pay on those closing costs, because there are limits sometimes, especially through secondary market loans. Portfolio loans, we're a lot more lenient on that. Your seller wants to pay all your closing costs, especially a primary home. We're good with that. We don't have a problem with that. Again, that's the good thing about being a portfolio lender in-house. We have a lot more range of what we can do, a little bit more freedom as far as what we require and don't require. So please keep that in mind. Let's see here. Also too, when I was talking about the 30-year fixed rate as opposed to a 15, if the 15-year payment is going to be too high for you, then or on our portfolio, if we have a 14-year, we also have on our portfolio, we have a 24-year payment fixed rate, and on our secondary market, we have a 20-year. So there are different ranges. There's not just the 30-year fixed rate and the 15-year fixed rate. So do keep that in mind. There's a whole range of different terms that you could finance at, and a lot of people don't talk about a 20-year fixed rate on a secondary market loan, but it is available. It is available. So you don't have that longer term of a 30-year, because let's face it, that's 360 payments. A 15-year is going to be 180 payments, but you could go kind of in between, do a 20-year, which is 240 payments. So that's something that you may want to look at, and just think about this. 15, 20 years are going to go by like that. And especially if you're doing a rate term refinance or something like that, or even a cash out refinance on your first mortgage, wouldn't it be great after 15 or 20 years to have your home paid off? If you had kids, young children, and they're going to college, your house is paid for. You have no mortgage payment. So do think about that. Again, I'm a huge fan of a 15-year fixed or a shorter term amortization if you can afford it too. Also too, when you're looking at your planning too, if you're dual income, you may want to also look and say, what if, and something happens and you lose one of those incomes, can you still afford that payment? So definitely you want to make some planning to make sure that you won't run into any problems. Also too, I tell people to have an emergency fund too. And especially, if you go to a shorter term amortization, just because if something happens and there's a medical emergency, you have money you can dip into to make that mortgage payment if you need to. So I think it's very important, whatever you do in life, you do need to have some type of an emergency fund. And that kind of rolls back to our 100% financing too, where you may have the money to put down, but you don't want to save that money for your emergency fund, put it back, have it in savings or something like that, and put you in a home, get you in a home. I always recommend trying to pay towards extra the principal to pay that loan down as quickly as possible, and you're building equity in the home. So that's kind of it in a nutshell, what we do here at TVFCU. if you have any detailed questions, please get those to us. We're looking for ideas to do some of our seminars, and we can go into more detail on some of these products too. If you want us to go into more detail about home equity lines of credit, we can do that. Investment property. Investment property, again, like I said, it's very popular. People are looking at homes because to rent. We can go into a little bit more detail on some of those. So send us your ideas, what you would like us to delve into a little bit more detail. Again, this is just a brief overview of what we do. And I see right now we've already done our drawing for the $100 Visa gift card. And Lindsay C., you are our winner. We'll be reaching out to you and getting your $100 Visa gift card. Also, everyone, be on the lookout for our next mortgage seminar for next month, month of March. We've got some great ideas. Again, shoot us some ideas. If you have anything that you'd like to talk about. If you want to reach us, you can contact us at tvfcu.com or give us a call at 423-634-3667. Again, that's tvfcu.com. Give us a call at 423-634-3667. Again, my name is Brian Fryer with TVFCU Mortgage Sales Manager. Thank you for joining us. Everybody have a great Monday.